If you're watching the headlines right now, it feels like the world is on edge. Tensions involving the United States, Israel, and Iran are escalating. Oil prices are reacting, gold is rising, and markets are volatile. And the questions many investors are quietly asking is, should I be worried about my money? Today, I want to give you something different. Not fear, not predictions, not dramatic scenarios. Clarity. Because hidden inside every period of uncertainty are opportunities, but only visible to disciplined investors. This is the mindful investor's lens. Let's begin. First principle. Markets react faster than reality. When geopolitical tension rises, markets don't wait for confirmation. They price in probability. If oil supply might be disrupted, oil rises. If inflation might return, bonds move. If central banks might delay rate cuts, equities hesitate. But here's the key insight. Markets often overshoot before reality catches up, and overshooting creates opportunity. Number 2, oil volatility, threat or setup. The Middle East is central to global energy supply. Any escalation introduces risk premiums into oil pricing. For UK households, higher petrol costs, pressure on heating and energy bills, and inflation sensitivity. For US households, gas prices at the pump, transport costs, and consumer sentiment shifts. But here's the opportunity angle. When oil spikes sharply, markets begin pricing worst-case scenarios quickly. If escalation cools faster than expected, oil can retrace sharply. Volatility in commodities often creates tactical opportunities, especially for disciplined capital allocators. Energy companies with strong balance sheets may benefit. Broad indices may temporarily discount fear. The mindful investor asks, is this structural or emotional pricing? Gold rising. What it really means. Gold typically strengthens during uncertainty. Why is this? Because it's perceived as neutral. No earnings risk, no credit risk, no geopolitical allegiance. But rising gold does not mean collapse. It means hedging. For UK and US investors, this raises a question. Should you hold defensive assets during uncertainty? Maybe, but not emotionally. Do it strategically. Small defensive positioning can stabilize portfolios during volatility, and stabilization creates optionality. Optionality is opportunity. Number 4, the liquidity lens, the real opportunity driver. Let's zoom out for a second. The real driver of opportunity isn't the conflict itself, it's liquidity. Here's the chain reaction. Geopolitical tension leads to oil volatility. Oil volatility leads to inflation expectations. Inflation expectations lead to central bank caution. Central bank caution leads to liquidity tightening. And liquidity tightening leads to risk asset repricing. When liquidity tightens, weak positions unwind. Over-leveraged players get forced out. Speculative assets fall faster than fundamentals justify. That's when opportunities quietly emerge. Not at the headline, but in the aftermath. Number 5, where hidden opportunities usually appear. Let me give you structured clarity. Historically, during uncertainty, opportunities appear in these 5 areas. Number 1, high-quality equities oversold. Companies with strong cash flow, strong balance sheets, and durable business models often get sold alongside weaker names. That's mispricing. Mindful investors build watch lists in advance. Number 2, dollar cost averaging windows. For long-term investors in the US and the UK, volatility can improve long-term entry points. You don't predict the bottom, you structure entries over time. System beats emotion. Number 3, defensive sector rotation. During tension, energy often outperforms. Utilities may stabilize, and consumer staples gain relative strength. Understanding rotation helps avoid unnecessary panic. Number 4, currency awareness. This is important for UK viewers. Global conflict often strengthens the US dollar. For UK investors, this affects imported inflation and overseas asset exposure. Currency awareness is an overlooked edge. Number 5, cash as strategic power. Cash is not laziness. Cash is optionality. During volatility, investors with liquidity can deploy capital into discounted assets. Investors without liquidity can only watch. That's the difference. The psychological opportunity most people miss. The biggest opportunity isn't in oil, or gold, or stocks. It's in emotional discipline. When uncertainty rises, many investors overtrade, sell at local bottoms, chase defensive assets late, react to social media noise. The mindful investor does something radical. They slow down, because panic transfers wealth. Every market correction is a transfer from emotional hands to disciplined hands. The US and UK context. Why this matters specifically. For the United States, the Federal Reserve's path on interest rates becomes crucial. If oil-driven inflation pressures policy, rate cuts could be delayed. Markets reprice quickly. For the United Kingdom, the Bank of England faces similar tension. Energy sensitivity in the UK economy means oil spikes can have outsized impact. But again, repricing creates opportunity, especially in strong businesses fairly discounted. Number 8. What not to do right now. Clarity includes restraint. Do not liquidate long-term investments out of fear. Overexposed to a single defensive asset, chase gold after large spikes, increase leverage during volatility, and do not consume endless alarmist content. Uncertainty magnifies poor structure. Structure protects capital. Number 9. The 3-layer opportunity framework. Here's your actionable system. Layer 1. Stability. Maintain emergency liquidity, reduce unnecessary leverage, and ensure expenses are covered. Layer 2. Strategic patience. Watch the markets, track bond yields, observe oil stability, and wait for emotional extremes. Layer 3. Disciplined deployment. Gradual accumulation of quality assets, structured allocation, and no emotional lump sums. Opportunity rewards preparation, not reaction. Number 10. Why crisis periods often create long-term winners. 2008 created opportunity. 2020 created opportunities. Volatility often precedes expansion, but only for investors who stayed calm, maintained liquidity, understood capital flows, and avoided emotional capitulation. The goal is not to predict escalation. The goal is to remain positioned regardless of outcome. So here's the final perspective. Global uncertainty is uncomfortable, but discomfort is not destruction. Markets are adaptive. Capital reallocates. Risk reprices. Opportunity emerges. The mindful investor does not celebrate crisis, but they understand its mechanics, and that understanding creates advantage. If this video gave you clarity, subscribe to The Mindful Millionaire, where we replace panic with structure. In the comments, tell me, are you positioning defensively right now, or preparing to deploy capital into volatility? I'll see you in the next one.